Hello, my name is Juliet, a master's student in the Department of Data Science at Seoul National University of Science and Technology. I will be presenting a paper review on the revenue forecasting for European capital market-oriented firms, a comparative prediction study between financial analysts and machine learning models. As digitalization and technology advances, there has been an increase in investing opportunities and access to real-time information for trading. So, sell-side financial analysts have long acted as intermediaries in reducing financial asymmetry, thus contributing to market efficiency. By using firm information, they prepare expected earnings, revenues, and target prices, which facilitate investors in investment decision-making. However, previous research has uncovered a conflict of interest between the covered firms, analysts, and investment banks, thus suggesting a lack of independence. For instance, in one paper review, it showed that financial analysts tend to bias forecasts optimistically in order to improve their access to management and to increase broker trading volumes. Thus, as capital markets depend on accurate forecasts for valuation and decision-making, revenue forecasts are increasingly becoming important to investors. Hence, the question arises, why choose to forecast revenue instead of earnings? Although expected earnings attract attention from investors, expected revenue plays a crucial role in investment valuation. Revenue forecasts are considered important as it has been observed that investors value a surprise in revenue more than a surprise in expenses. Also noted in one research paper was that revenue forecasts are important in the investor's valuation process, since the capital market rewards a firm that meets analyst revenue forecasts separately from meeting earnings forecasts. Also noted in another research paper was that earnings forecast revisions followed by revenue forecast revisions had a significant market trigger compared to standalone earnings forecast revisions. This paper seeks to answer the following questions. So the first question is, can predictive models provide better 1 year ahead revenue forecasts compared to financial analysts? And the second question it seeks to answer is, can predictive analytics provide consistent and accurate results across industries over time? The sample dataset consists of firms listed in the European Union 15-country blue chip index for the last 1 year, between 2010 and 2019. Blue chip companies are used as they are seen as representatives of leading companies in the country. Also, the sample period reflected a period of relative economic stability in the European Union. The companies considered are those that adopted the IFRS for the consolidation of their financial statements on a mandatory basis at the time of its introduction in the European Union in 2005. The original dataset had 699 firms. 3 data sources were considered. So the first one is for the analyst forecast. The institutional broker estimate system was used to obtain the data. For the second source, to obtain firm-level data, Refinitiv Econ was used, and for the third data source, to obtain macroeconomic data in terms of the country, Eurostat was used. The approach considered was to compare how machine learning model forecasts vary, or if they're better than financial analyst forecasts. The original dataset had 699 firms. However, while cleaning, cross-listed firms were assigned to their country of domicile. Firms with non-December 31st fiscal year ends were excluded, and firms listed on the stock exchange after 2010 or those discontinued during the sample period were also excluded. The remaining firms were then matched with the mean revenue forecast from the institutional broker estimate system, which were the revenue forecasts submitted by April 30th of the respective fiscal year. This was done in order to establish a temporal comparable information basis between analysts and the models. In the final step, the firms are matched to their corresponding revenue values and financial statements using Refinitiv Econ. Excluding missing values, the final dataset consists of 300 individual firms and 3,000 firm-year observations. Other macroeconomic variables such as the GDP, unemployment rate, and inflation rate at country level were also added, and the firms are also categorized according to the 12 industry classification themes specified by Farmer and French so as to incorporate industry fixed effects. Some pre-processing steps undertaken included data vectorization, handling of missing values. The data was also standardized and feature extraction was undertaken. To evaluate the performance of the models, the following metrics were considered. The first metric was the mean absolute percentage error, which measures the absolute percentage error between the predicted value and the actual value. The second metric is the median absolute percentage error. So this method is considered like more robust to outliers, as it uses median rather than mean. It's especially useful where positive and negative error should be weighted the same in evaluation. The third metric was the median symmetric accuracy. Given the first two methods are only defined for positive values, this formula considers the case where either the predicted or the actual revenue is negative, and the last metric is coefficient of determination, also known as the R-squared, which indicates what proportion of variance in the actual revenue values are explained by the predicted values. It's a useful measure for analyzing how well a model fits the observed data. Looking at the summary of results from the predictive analytics model, the first model, the linear regression, which assumes a linear relationship between dependent and explanatory variables, the results show a comparable mean absolute percentage error and R-squared, but there is a significant deviation in median absolute percentage error and median symmetric accuracy. So this model is concluded to estimate outliers that deviate considerably from the actual revenues. The next model, which is the decision tree, yields a much small mean absolute percentage error. Considering the R-squared, the value of 90.7% is considered good, but is still lower than for both the regression and the analyst prediction. The random forest shows an improved performance for all the performance measures. The mean absolute percentage error is 13.29%, median absolute percentage error is 6.69%, and median symmetric accuracy is 6.85%. This indicates that the prediction is affected less by outliers. Even though the mean absolute percentage error is lower than that of the analyst, the median measures show a slight deviation from the analyst value. However, looking at all the measures, the random forest provides the most competitive forecast. The neural network provides a better result than the regression model, but the predictions are not as accurate as those of financial analysts and tree-based models. Considering the model performance from an industry-level perspective, the machine learning models have a comparable or better prediction for majority of the sectors, for example, for the finance and insurance companies. Comparing over annual time periods, even with the changes made to the accounting standards in 2018, the random forest model performs comparable and in majority of the years performs even better than the analyst's prediction. Looking back at the research objectives that this paper aims to answer, first, we have seen that the predictive analytics models can rival the financial analysts in revenue forecasting. In particular, the random forest model performs best, resulting in a much lower mean absolute percentage error of 13.29% compared to the analyst's 59.48%. For the second research objective, the results show a comparable or better prediction performance for majority of the sectors. Thus, the study conforms to the findings of the complete data set, therefore demonstrating the industry applicability of machine learning models. And lastly, from the year 2010 to 2019, The random forest provides comparable results to the analyst's forecast even with the changes in the accounting standards. Thus, you can see the machine learning models are also able to withstand the time frame change. Financial analyst predictions can be limited due to reputational concerns. However, these limits can be overcome through the use of machine learning models which provide transparency and increased objectivity during the forecasting process. Due to the transparency and ability to use more data, predictive models are a time-saving alternative to traditional analysts and are helpful in reducing information asymmetry, thus promoting capital market efficiency. Financial analysts can also use the results from the predictive models as a baseline comparison for their own forecasts. The study, however, listed the following limitations. Firstly, the underlying sample consisted of only blue-chip companies, hence does not cover the full variability of firms within these countries, which limits generalization. And secondly, the time period used is considered a time of economic stability, hence it is unknown if the model will behave similarly during economically challenging time periods. Thank you for listening.